So we have more time for discussion, that means. So the way I would like to go ahead is that I have a few comments on the three papers to launch the debate. Maybe we can then, if the panelists have a reaction to my rather brief comments, they can take these immediately, or we pass directly onto the floor to have this interactive debate, which I hope will emerge from this. Let me go in reverse order. Let me start with the liquidity and the reserves and then come to the capital and the provisions. So let me first say that in our profession, the microstructure research on money markets and banks' liquidity behavior was until quite recently a very under-researched area. I know what I'm saying because I wrote a paper in 2000 about the microstructure of the euro money market, which was the first paper on this, and had lots of these questions of how the behavior of central banks and micro behavior of banks affected actually this market. So, and that was something that, and we have in the ECB actually talked about the forgotten markets because nobody was interested in them until this crisis. So in that regard, this paper is a great contribution in paying more attention to a much forgotten market, which actually can be so essential in situations like the ones we have here. So let me come to the comments. So I have a small number of comments and questions. So my first question is actually in the paper, in the version of the paper that I had available, you also found a break in the liquidity holdings and the reserve holdings in March 2007. So, and I didn't see it any longer in the chart you showed anymore. So at that point, I don't know whether this was something that was afterwards revised. So my question was whether there was actually, I mean, March 2007 was a very early period. So whether that had some early warning type of characteristics or not, or whether this was something spurious that was corrected afterwards in further revisions of the paper. My second comment is, actually my suggestion is there is both in the analytical discussion and in the policy discussion, there are two competing hypotheses about the interpretation of this liquidity hoarding. So one is the emphasis of your paper, which is that basically banks hoard liquidity because they fear in the stress situation that they may be hit by further losses in the future, and therefore they hoard their own liquidity and they are buffered better. So it's more an expectation, it's more concerns the bank's individual situation itself. That's one hypothesis how people have explained this liquidity hoarding. The other way is that this is a market problem, a problem of distrust among the banks with each other. So it is, they're not conflicting, these two. They can exist both at the same time. But if one is the main one or the other is the main one or both together, the policy implications can be different. So the other is that actually banks distrust other banks because they fear that actually the other banks may be in bad shape. And if they would lend money in the interbank market, in particular unsecured money in the interbank market, they would lose the money, so they rather hoard the liquidity, for example, in central banks' reserves. So the response to these two problems in terms of policy can be different. For example, the second hypothesis could be explained by what we call adverse selection. Simply, in the heat of the moment of the stress, you can't distinguish the good and the bad banks out there, and you stop lending to any bank that is out there. You hoard the liquidity that you would have, and you would basically, since many banks may be doing this would lead to a breakdown or freeze of the market. Now, your paper mentions both hypotheses, but is mainly in the area of the first. And my suggestion would be, or my question is, you have made some controls, maybe you can explain to us how you accounted for these other hypotheses to strengthen potentially in this analysis this other direction of research which would deal with the distrust of the markets. I think we have heard it also today in the speech in the first session that this also plays another role. But these two are an important role in the present situation, which is not your sample, I understand that, but maybe a more balanced discussion of these two elements and a sharper way of discriminating between the two would be helpful in that we could then think about the relative policies and their relative importance in this light, rather than having the rather stronger emphasis on the liquidity holding. On the liquidity hoarding caused by the more contained view on the banks themselves that are concerned. My last remark is just to further expand on policy, asking you also mentioned the Bank of England intervention at the end, which is something that is not tested in the paper. The effect of this is not tested in the paper, but there may be other interventions you may want to refer to. And the last is whether you have any in your paper any messages that would talk to the new liquidity regulations that we have in Basel III, notably the liquidity coverage ratio or the long-term funding ratio, whether your research makes any suggestions on those regulatory sides. So these are my comments on the last paper. Let me move on to the other two papers. So undoubtedly, these two papers throw very important insights to an extremely important debate that is taking place at the present times. But let me throw a particular angle on each of the papers, and then let's try to scratch a little bit on the surface about the results, challenging some of the results. Let me first talk about the context. So when we talk about Charlie's paper, so it speaks to two issues. One is really the effectiveness of capital requirements, or say that how drastic the effects is on the loan supply in the economy. And the other is really this, if you want, regulatory arbitrage questions. If you raise regulation in one area, does it migrate to other areas? And here the case of actually foreign branches in a local market is the key issue. Now these two perspectives have different issues to it. So one is, of course, there is actually a controversial debate, as we discussed over dinner yesterday, about how harsh increased capital requirements are really to the banks. And so this paper, in a series of other papers, make the case that actually, and some of them were actually also some important quotes were put up by Jose in this regard, that actually the effect on credit is really drastic. So one interpretation would be in the efforts to increase the buffers in the banks, and now talking not about the cyclical neutral ones, and I'm talking about the level, the structural level, that actually you have to be cautious to balance well the reductions in risk with the constraints and opportunities in letting economies' growth be financed. And there's another a branch of literature who exactly challenges that and says the cost of equity are not all that high. There have been macroeconomic estimations by a BIS group called the Macroeconomic Assessment Group, who actually, with macroeconomic models, estimated the effect of increased capital requirements, in this case, particularly the Basel III plans, and came out with relatively benign effects on lending. And of course, on the other side, again, if you read the Institute of International Finance, the industry body, again, is on the other side, claiming that there could actually be rather drastic growth effects of these regulations. So that's one perspective of the paper, and the paper takes a clear position, in my interpretation, in this debate. The other is this question of the regulatory arbitrage. Let me illustrate the importance of this question. And first of all, it's obviously important for bodies like the Financial Stability Board, for example, that has to have a balanced approach among the major economies where banks are competing so that there's a level playing field across countries. But in the current situation, actually, we have also an important European issue in this regard, which is the following. There's a draft directive, CRD4, by the European Commission, which talks about macroprudential policy instruments. So the idea is there's going to be a list of macroprudential policy instruments, and the question is really, one of the questions is that this regulation, the draft at least, imposes what is called, it suggests maximum harmonization, which means that it's not only a minimum for Europe, the macroprudential policy, it is also a maximum. So a country couldn't, in this draft, couldn't choose to go beyond, saying my property cycle is different. I have to have a higher capital buffer than the UK, have to, in a given point in time, a higher buffer than Germany, let's say, because I have a different credit cycle. And so this launched a debate about actually, is that a good idea to have maximum harmonization, or to actually allow banks to have, allow countries to have country-specific calibrations, the same instrument, but calibrated to the purposes of the country. And that debate is going on, and we have to see what comes out there, but my expectation would be several countries are very keen on actually making sure that they can actually respond to their national credit cycle and are not constrained by a total harmonization either of the calibration of the instruments. Now, of course, once you do that, you have the types of problems, or you may reinforce or not, depending on how it is done, these types of problems, in terms of that, for example, not only the branches in your country, but also the cross-border competition or the more wider level. And the question is, do we need a type of coordination of this? So, for example, an idea could be, let's give the freedom to the countries to calibrate their national capital buffer, but then we need some calibration. And Mr. Constancio, who spoke to you this morning, has actually given an important speech last week representing the view that actually this should be, that the country freedom should be given for the countercyclical capital buffer in the EU, but it should be coordinated and ex ante by a European body like the European Systemic Risk Board, in actually exactly to balance out these type of problems. So having the flexibility where necessary, but having a European-wide thinking body that would actually, in our single market, ensure the proper functioning of the single market by actually taking this into account, and from an ex-ante perspective, so is the proposal. So I wanted to put this paper in this very important context. Now, having said that, of course, my job is also to scratch on the surface of the things, to challenge the results. Now, I don't have very sophisticated insights, but as you heard from me over dinner yesterday, I have some doubts about this one-to-one effect, basically that the estimated elasticities basically suggest that, that the direct impact effect of an increase in the capital of these UK banks would be a one-to-one reduction in the credit. So basically no substitution would be taking place in the funding sources to the effect that actually the banks could cushion. In the contrary, all the compensation would happen through foreign branches that, by the definition of a branch, would not be supervised or regulated by the UK authority, and actually also this effect is very large. Is actually I think, if I remember correctly, 1/3 of the initial one-to-one effect would actually compensate it because these foreign branches come in. Now, I have some doubts about the size of actually both effects, and I wondered, like, what could be sources of this effect, which actually is in every specification you have highly significant, and that's so enormously significant, and also all other variables in the same estimations are insignificant. And so these type of observations tell me I have to question this result. So what could be, so one suggestion I would have is that you present in the paper systematically the two-way fixed effect specification where you control for not only individual effects but also time effects. You say in the paper that you actually have them and they show the same thing. But given some of the doubts that I will raise afterwards, so I think I would just systematically have the time and individual effects reported, so to make them go away. The second thing is just, I mean, I know your identification strategy and also saw your very smart way in controlling for demand, which is the key issue here. Actually, the José's paper illustrates very clearly the challenges in controlling for demand. If you want to identify supply effects, you do it over the different sectors. You didn't have the time to explain that really in detail. Despite the fact that this is a very smart way of doing this, I mean, I feel like, shouldn't we control for a number of macroeconomic variables despite these approaches you have, interest rates, monetary policy, a variety of things, and I would be more comfortable if I would see the same results with these type of additional controls. I understood they're not there. I hope I didn't overread anything. I would also report like simple statistics of fit, like R squared. And so, for example, in the present version of the paper, we don't know how much of the variation of the explained variable is actually explained by the variables that are there. So seeing a number there that is more than negligible would give me confidence. So this was my very unsophisticated attempt to scratch on the surface of these results. Let me just mention that there's actually a few other papers now coming up on related issues. One written by, and conveying a similar message as Charlie does with his issue 2, by Alex Popov, Stephen Ongena, and Greg Udell, who actually look how the national regulation, if you enforce regulation at home, not affects the lending behavior of branches you have in the same country, but how it affects the lending behavior of the same banks to firms in other countries. And actually they find also a significant spillover effect with the interpretation that actually if you have either a more prudential or a more competition regulation at home and that constrains your risk-taking, actually banks tend to actually shift that risk-taking to countries abroad that don't do the same thing, and this is independent of whether you operate with branches or subsidiaries abroad. So it's independent of how harsh the foreign regulation is. Even with branches where the home supervisor has to have full control, in theory at least, with the foreign lending, this effect is visible. So I found this is this flip side of your result, like saying your foreign lending.
Chettarelli and Goldberg have similar results too. In a related paper, I agree with you, it's relevant.
Okay. I think these were my points on the Does Macroprudential Policy Leak paper. Let me briefly come launching the discussion on the on José's paper. It's a paper that was produced to a large extent at the ECB. Obviously, it's a great paper. It's fantastic. It's unbelievably good. No, more seriously, I mean, what we should, I think, state is that, you know, we really here, this is really a frontier piece of research in its approach to identifying loan supply and loan demand. These credit register data give you unique opportunities to do that, and it's, and in this and several other papers, it's done in an extremely careful way. And I doubt that there's any data set or any approach how you could do it better. This type of credit supply identification, which is so important for policy interpretation. It's very hard to do it better with the given technologies we have and the data we have. I mean, this is the most detailed data you can imagine. Having said that, I mean, there is a few leaps in how the paper is presented in terms of its interpretation for macroprudential policy. So, I mean, I would be a bit more modest in some of the interpretations. I mean, a cheap point is, of course, it's a bit unfair, this point, I know, but everybody says it. So even in Spain, the dynamic provisioning didn't prevent the property bubble. So we also need some other things. So this, we see in the data, it's effective. It makes a difference whether you use dynamic provisioning. You should think about it also in terms of capital versus dynamic provisioning, or in terms of what you can learn about capital, but apparently it didn't do all the trick. There's also something more to do. And the second point is that you have heard from me also before, Jose, so is that, I mean, dynamic provisions is not exactly identical to regulatory capital of Basel III. So regulatory capital of Basel III is Tier 1 capital, so issued equity and retained earnings. And these dynamic provisions, they have not been in the past, as far as I know, but now are included in Tier 2 capital. So making a direct analogy between the two, they I think, require some qualifications. And actually, it would be really interesting to discuss the differences, maybe not in this paper, maybe in another paper, about actually what does it mean to work on Tier 1 capital as opposed to Tier 2 capital, which is extremely relevant for what we have in Basel II right now. And then again, I have my cheap shot on the macro controls. Also, the identification strategy is very good, is very careful, and it should not bias the results. But if I don't, these credit register data from Spain don't have the interest rates of the loans. That's the one little caveat you have in there. So you have all the loans with all the information of the borrowers, the lenders, and review. But as far as I know, you don't have the rates at which they are given. So there is some interest rates out there in the economy, and the question is a little bit like, does it make a difference if you throw them in, or if you throw in an aggregate interest rate or other macroeconomic variables? This is my little trigger, so I would now give opportunity to all the three panelists to have a quick reaction, and then open up for the wider debate. I don't know. You want to start, Charlie? Yeah.
First, thanks for the great comments. I'll only respond to some of them because the others I'll just take into account. In terms of the macro controls or the time effects, they don't affect the results. Now, we do have GDP growth in as a control, but we find that the one thing that would matter in the absence of time effects is to put, not for our result, but it is useful to include macro controls to see the effect of monetary policy on credit growth, as it is in Kashyap and Stein's work, but it doesn't matter much for the capital requirement changes, as our results show. Now, another thing I wanted to say, because I think you're right about this balancing issue of the balancing some domestic autonomy versus the need for coordination. And I should say two things about that. First, I don't have an answer to it yet. I hope I will, because as you know, I'm supposed to, because the body that you said is supposed to sort this out, I've just been appointed to advise, which is the European Systemic Risk Board. So I'm hoping you're going to tell me what the answer is to this knotty problem. Now, in terms of the debate going on right now about capital requirements in this BIS group study, I want to emphasize something. I just think that when there are, let's say, 20 microeconomic studies across time and place that all have the same conclusion, and we have one macroeconomic study that doesn't agree with them, I think that macro data are probably inferior, sort of. I would give them a lower weight. So I want to emphasize that even though our two studies are the first studies that have micro variation within a panel, and they are in agreement, also I would emphasize the size of your effect should be smaller than the size of my effect, because your effect gets automatically reversed, whereas ours doesn't. But there's a long literature that's finding the same thing, and that literature has, in addition to our papers, there are papers that looked at countries where they had a capital requirement regime change. It's not as good as either of, I would say, in terms of the variation in these two, but they found consistent results for individual banks. Then there are a whole bunch of papers that look at changes in capital as a result of an exogenous loss, where there's a constant capital requirement, and they find a credit supply shock effect. Rosengren's work, Peek and Rosengren's work, which is sort of like the predecessor of the paper that you mentioned, the Popov, Ongina, and Udell paper, they're finding that Japanese banks had a big contraction of their credit supply in the US as a result of their shocks to their capital and their home organization. And so I think what I would say is I think there's really a pretty unanimous view on this, and I don't mean to be too argumentative with the other side of it. Now, in terms of the size of the effect, my final comment, I agree with you. The size of the effect seems really large. By the way, we do have some additional ideas about possibly instrumenting the first regression I showed. We'll see if it works. But I want to point out there are 4 independent, consistent findings about the size of that effect. 4 different things. Number 1, we find the effect itself, an elasticity of -1 in that first regression. Secondly, I didn't mention this, but we ran equivalent regressions for the change in capital. So notice that there's a change in a ratio, and what we're saying is the denominator is doing all the adjustment. Well, if that's true, if you run the same regression for the numerator, you should see 0 adjustment, and that's what we find. That is, changes in capital requirement ratios have 0 effect on the growth of capital. And third, we're finding that the buffer is basically constant. So the fact that you're seeing that the denominator has an elasticity of -1, the numerator has an elasticity of 0, and the buffer between the requirement ratio and the actual capital ratio is unchanged, those are mutually consistent results, and they're all independent. The fourth independent result is that the banks that are in the competitive niches that are unregulated respond hugely too. So that the sizes of the response in terms of their sort of order of magnitude are sort of comparable. So all four of those are independently generated, and they're all consistent with this being a huge effect. That said, we find the effect large too. So I'm sympathetic.
Maybe in logical order then Jose.
Yes, Philip, many thanks for your very nice words. Relative to your questions, the first one is whether, so basically if the denied provisioning was so effective, why Spain had the crisis? And so there are three reasons in a sense. One is it's effective in the sense of reducing banks' credit, but firms are not so affected. So the leakage of that Colomides was showing was very strong in the good times in Spain. Second, as I said, there was a reduction, an important reduction of provisioning in Spain in 2005. So basically, as I said, in 98, Spain had the lowest level of provisions in the OECD. In 2004, the highest, and because of that, the banks, the commercial banks, were pushing, and there was an important reduction of denied provisioning in Spain in 2005. And the third thing is that monetary policy, as we have several papers showing that monetary policy, the interest rates were very low in Spain, and that created an important boom in credit and risk-taking. So that would be, I guess, the reasons. The second question is the difference between provisioning, this denied provisioning, and capital. So it's tier 2 capital, and it was also tier 2 capital in 2005. Now, capital is own funds by the bank, own funds, retained profits by the bank, that's capital. And maybe the purpose is not general losses, not specific losses, but other losses. And denied provisioning is all those things. So it's very similar, it's identical to capital in that sense, in the sense that our retained profits, own funds by the shareholders of the bank, and the purpose is not specific losses and not general losses. So unexpected losses, this dynamic provisioning. Yeah. And finally, the macro controls, so whether we have an interest rates for the economy or for the banks. So controlling in our setting by these firm time fixed effects, that is controlling the different lending by the different banks to the same firm at the same time, is controlling controlling for all time varying heterogeneity in firm characteristics, including firm level interest rates, macro level interest rates, everything that varies at the macro level or at the firm level. The only thing that we cannot control for is previous interest rates between that particular bank and that particular firm. But the way, as I said, we analyze this firm price, we think is innovative and I think is persuasive, which is we have the shock, I am the firm, I have committed loans with two different banks. After the shock, I start borrowing more, drawing down more the credit lines for a particular bank. That must be the price, is reduced. Cannot be another thing. So basically, we will try to address that.
So related to your first question, in a old version of the paper, we looked at a more aggregate measure of liquidity that included collateral posted at the central bank. But we removed this from the new version because this collateral cannot be used to raise liquidity in the interbank market. It's held for regulatory reasons. So we did find that banks posted more collateral ahead of the crisis around March 2007, but this effect was quite small compared to the others. And since the framework had been introduced since 2006, we were not sure is that a cyclical small effect or what. So we didn't give it much weight in the end. Regarding the second question, I think we we go some way towards isolating a precautionary reaction that is unrelated to counterparty risk when we relate the liquidity demand of banks to an aggregate measure of payment activity, which is exogenous and unrelated to counterparty risk. A second exercise we do is show that this reaction to a higher payment risk is higher for the weaker banks, for my own risk and not my counterparty risk. And we, in a new version, added an analysis using bilateral data where we control for both lender liquidity endowment and borrower liquidity endowment. And we find that the increase in the rates that we observe in the aggregate data is really linked to lenders' behavior and not borrower risk or liquidity endowment. Regarding the last question on implication of the Bank of England policy interventions, we did not in the paper analyze what effects this intervention had on the market directly. We didn't estimate a reduced form of the effect of the reforms or the interventions on the market. One reason is that these interventions are endogenous, so we didn't want to get into this. Regarding the specific schemes, such as the special liquidity scheme or the standing facility and the stigma attached to this, I had done an analysis of whether there is stigma attached to the special liquidity scheme, but this is very confidential and I was not allowed to go very far with this. I think our analysis shows that what the Bank of England is aware of is that more banks participating in the reserve scheme would help in these cases. One factor that has exacerbated the instability is the fact that it's such a concentrated market with 4 banks really playing the role of intermediating liquidity around the system. So having more banks holding a buffer at the central bank would help. And more generally, for liquidity regulation, our results show that a wider self-insurance in the banking system would help as well.
Thank you. Let's open up. So, question time. When you get the microphone, before you ask your question, please state your name and affiliation, and try to make your questions concise so that they're easy to answer. So far for my interactive approach. So okay, here we go.
Thank you. Giorgio Spriano, I'm a risk manager in Intesa Sanpaolo. More than a question, 2 considerations which, as a matter of fact, are a question to the 2 gentlemen on the countercyclical buffer. The first is that the 2 papers, as a matter of fact, analyzes very single effect, of a single shock. The first one was the effect of Basel I. The second one is the effect of a very precise measure on, on provisioning. My consideration is, what about doing the same exercise today, when we have several regulatory actions taking place or being introduced more or less at the same time? We have Basel III, which is already a mix of different measures on nature of capital, on countercyclical buffer, on leverage ratio, on liquidity, being introduced in a moment in which banks are rolling over Basel II still, moving from standard to internal method. And on the top of that, talking about buffer, we have the systemically important financial institution reform just on the corner, around the corner. So the question is, having a mix of measure would be methodologically possible, but also what do you think would be the overall effect? Because there is the risk of having a credit crunch due also to the confusion and to the lack of understanding of the combined effect of these measures. So this was the first question to both of them. The second question refers to the paper from Spain and countercyclical provisioning or looking forward provisioning. Nice. The point is, if good times come first, it works well. What about if bad times are present and you don't see when the good times will be? And which is really the real question also on the today discussion on countercyclical buffer. I mean, are measures to be introduced using a crisis or not?
Let's see whether there maybe collect a few questions. I hope there are a few questions, so then I would collect. Here we go, the gentleman in the front.
Thank you. Jose Barros, Federal Reserve Board. Okay, I guess I have a couple of questions and perhaps a comment for Charles Calomire's paper. The first one is, so my understanding is that you're using Basel I capital ratios. So this is either Tier 1 or Tier 2 as a fraction of risk-weighted assets. Have you considered adjusting those for off-balance sheet operations? If you think about the recent debate in Basel, it's been mentioned that changes in the regulation are just around the corner. And I guess some of the big role there is off-balance sheet transactions such as securitization activities or even the role of derivatives. Having conducted research on the effects of bank capital on lending myself, I guess I agree with Philip in terms of the big magnitude of your coefficient. Actually, for a sample of large banks in the US, my co-author and I found a third of the size of your effect. And part of the interpretation of that was, well, maybe by using Basel I ratios, we're not really capturing the essence of the risks that banks were taking, especially during the boom. So we sort of provide a potential interpretation for the results being, well, maybe if we were to capture all these off-balance sheet operations, maybe we would be able to capture this effects. That's why I asked this question. And the second one is, can you provide sort of an intuition for why banks with larger buffers would sort of have a higher sensitivity to changes in the regulation? A very simplistic view would say, if I'm operating way above the minimum regulatory requirement, I would have more flexibility in terms of leading with potential regulatory pressure. And actually, the third one, if you allow me, is, do you control for potential nonlinear effects of size? If I think of the US, think about the top largest bank holding companies. Their size is just completely different from even the largest banks in the second tier. That might perhaps explain part of the big effect that you're finding, the one coefficient. But thank you.
Are there any other questions? I mean, we also have to think about lunch. But if there was one more urgent question, I would still take it. Otherwise, I think I turn to Charlie and Jose. I don't know, you want to start? Because I think all the questions were addressed to the capital papers, right?
I think those are all excellent questions. Let me deal with them in reverse order. Jose's first. Remember that we have total capital requirement and we have total capital and total risk-weighted assets. So there's nothing missing from the regulatory requirements. There's no off-balance sheet. We're not only looking at one set of balance sheets, we're looking at the overall entity. So there's nothing missing from the requirement that we're looking at. If there's a trading book, for example, we capture that too. Now, I do agree with you, though, that large banks, especially those who are operating internal capital markets, are going to turn out. In our second paper, we're finding when we include monetary policy controls, we do find, especially, and when we use particular size cutoffs, we can find that cutoff. But it turns out that the result doesn't change by anything like the magnitude you're saying. So it goes down to about 2/3 of the size of our result, but the average result stays the same. So the small banks get bigger. On the endogeneity of the buffer, on the question of why the buffer should matter in the opposite way you're thinking, basically there are two opposing effects. One is a within bank effect, conditional on the targeted level of buffer. The other is a cross-sectional effect having to do with cross-sectional variation in the targeted buffer. They work opposite to each other. Your intuition is about the within bank effect conditional on a targeted buffer. But there's unobserved cross-sectional heterogeneity that's driving the cross-sectional differences in the targeted buffers. That turns out to drive the result, which is and it's the same as that corporate finance literature that I referred to. So we're in pretty good company. Let me move on to the other paper, or the other question. So yes, I'm worried about overkill. I have to choose my words carefully about this. This is a scientific paper, not a paper that's meant to be a sort of unqualified endorsement for raising capital requirements to deal with, or using macroprudential just as it's envisioned in some particular way. We're just saying this is a potentially useful tool. Obviously, you have to take the totality of all the regulatory requirement changes into account. I agree with you. I would like to, though, express an optimistic note, even during this crisis. What is the country that most effectively used macroprudential regulation on a sort of feel-as-you-go basis to have a soft landing during the financial crisis? It wasn't Spain, it was Colombia. And Colombia tried to raise its interest rates by several hundred basis points in 2006 and 2007 to try to cool credit growth, and it didn't work. And then they used capital requirements and liquidity requirements, and they achieved a soft landing. So I think I'm optimistic that while we don't know exactly how to parameterize this based on some models, that we can feel our way, and that I think we'll be able to figure out how to use this tool.
Jose, you want to add something?
Yes, to the last question. Yeah, it's true that in our setting in Spain was first the good times and then the bad times. And right now we're in bad times, and it's more difficult to raise capital requirements. Now, I think we have it also in our paper, which is when in 2000 they increased the capital requirements, some banks were much weaker than others. And what we see is that the reduction of credit supply coming from higher capital requirements was stronger for the very weak banks. And in that sense, this is suggesting that the elasticity that we find in 2000 will be much higher nowadays. Because nowadays, the average bank might be weak, and therefore, that will be, in our setting, the weakest banks in 2000. And elasticities are high, negatively high. So yeah, it might be a credit crunch after increasing capital requirements right now.
Okay, that concludes the morning of this conference. So let me first thank all the three presenters for their talks with a great applause.